It was a quiet day on Wall Street with most major indices hugging the flat line here today. However, don't let that fool you. We did have some pretty big movements in other areas outside the stock market, most specifically within the bond market. Bonds were surging here today as interest rates rolled over hard. The other interesting development is that the stock market did not give back yesterday's huge gains. Instead, it kind of held the line. And what we ended up seeing today was a lot of overbought cluster signals, not just on the S&P 500, but also on a number of the sectors within the S&P 500. Coincidentally, we did touch 4,100 on the S&P 500 today. Of course, that's been an important level that traders have been looking for a while because that's the underside of that falling downward trend line. And with tomorrow being the important jobs number, it has that potential for the bears to take over and start rolling over on this market. So tomorrow will be a very important day as we head into the weekend. We'll talk about all that in tonight's video, and then we'll get into our trade application example where I wanted to focus on a gaming company that is part of an arbitrage right now with one other company trying to buy it out, but it's looking like it's bouncing up and off of its moving average nicely to the point where we can do what's known as selling a bull put spread on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 1st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list. And remember that that's where you'll find those overbought and oversold cluster signals, which I haven't looked yet today, but I would anticipate there'll probably be a handful of overbought cluster signals in tonight's email because the S&P 500 closed with one. So tonight should be interesting to look at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, feel free to follow me. My handle is @BrandonVanZ. We really appreciate those of you that support these presentations by clicking like and retweet on those posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, we've got our heat map pulled up here for the S&P 500. A little bit more of a mixed session here today. Yesterday obviously was quite one-sided. Markets were basically green across the board yesterday. I didn't get a chance to listen to David's presentation, but I'm sure he shared that with you. So yesterday was a monstrous move higher. Everybody was wondering how would today come about? Would there be a follow-through of yesterday's bullishness? And we didn't really see that. And a reminder that today is the first day of the new month, and you guys have heard me mention sporadically throughout the years that have been watching this video that the first trading day of the month typically is bullish. It's a very strange fact that if you were to go back and look at all of the days of the month to see what one is the most important day, it's usually the first day of the month on average. Obviously, not every month is that way. But surprisingly, a huge chunk of the market's all-time gains is a direct result of the first trading day of the month. So more times than not, if you're kind of leaning on the fence and not sure what direction it's going to fall on the first trading day of the month, you're far better served leaning a little bit more bullishly. But today we didn't really get that. Today was one of those rare days where the market was down just a touch on the first day of the month, probably because it got more than it probably deserved yesterday with the massive up move. The other thing that I would mention is that while the market itself was down by, I think it was 0.07% today, so in other words, just barely under the break-even line, this was another day where we had more stocks that were up than were down. Remember, we had that conversation on Tuesday as well. In fact, let me go ahead and just share that with you while we're talking about it. Here's the visualized tab of the S&P 500, and there were 257 out of the 500 stocks that closed higher today, so just over the the 50th percentile at 250 even. So we actually did see once again more stocks closing in the green than in the red. Not by much; it was kind of like 51%, but still point holds that there were more stocks up today than down, and therefore you could say that the bulls didn't roll over at the same time, right? Sure, they might not have followed through after yesterday's big move, but they certainly didn't roll over. Now, who knows? Maybe that happens tomorrow. We did hit 4,100 here on the S&P 500 today, so we'll talk about that a little bit more when we look at our charts. That was an area that folks have been targeting for quite some time, and it could very well be the last stand there. If the bears are going to make their move, this is their moment. And remember, tomorrow is a fairly important day from an economics report perspective, as we do get some jobs numbers coming out, and depending upon how the markets interpret those numbers, the bulls have their chance just to blow this thing out of the water to the upside. On the other hand, if the bears are going to make their move, tomorrow could be the catalyst in order to kind of help facilitate that. So we shall see soon enough. But for today, it was just a quiet day, perhaps in advance of that storm. In terms of some of the bigger movers here today are the bigger companies affecting the market. Remember on Tuesday I had mentioned that a big reason that the S&P 500 was down despite more companies being up was because of Apple. It was down over 2% that day. Today Apple was actually up a little bit, so we can't really blame Apple today for the S&P 500 being down. However, you will notice that a lot of the other mega cap players did close lower today. Microsoft was down by 0.18%, Alphabet was down by 0.17%, Amazon was down by 1.08%. United Healthcare was down by about 2%, and even the big banks like JP Morgan and Bank of America were down. Berkshire Hathaway was down just a touch. So as you can see, those are some of the bigger squares and rectangles on the board. And outside of Apple, which just barely closed in the green, the rest of them were in the red. So again, that kind of makes sense why the overall results of the S&P 500 were down today, despite more smaller companies being up. In terms of where we saw kind of more consistent behavior, I'm not really seeing any of the clean sweeps like we saw on Tuesday. Remember that day, I believe it was the real estate sector. Every single component of the real estate sector was up on Tuesday. So today we didn't really have that experience with any of these 11 sectors in front of us. I would say that in general, tech seemed pretty strong. So if we were to kind of zoom in on tech, I already mentioned that Microsoft was down, and you'll also see that Salesforce was one of the worst performers today in the S&P 500. In fact, I think it was the worst, down 8.27%. They did report their earnings, so that's why they were such a standout to the downside. On the flip side, you had SNPS, Synopsys. This is actually one of the stocks in our coffee can portion of our top-down trend trading portfolio. They reported earnings that pleased Wall Street a little bit more. They were up 5.4% today when it was all said and done. You also see that NVIDIA had a pretty nice snapback rally, up 1% today. MasterCard had a nice 1% rally. Cisco was up 0.5%. So it does seem like the semiconductors in general, from an industry perspective, were down. But in terms of the broader tech sector, we had more winners than losers there. In terms of some of the other areas, let's go through them. Looks like we were a little bit more on the downside there with communications, probably about a split there in discretionary. Looks like the staples were reasonably strong. A couple of outliers. Costco was down significantly. It's not every day you see Costco down 6.5%. That's a pretty rough session for them, and I would imagine that was earnings related. Also notice that Archer Daniels Midland was down quite considerably. That's not something that pleases me as somebody who's interested in dividend aristocrats like that. But nonetheless, of course, Archer Daniels has been a fantastic stock for the last 5 years. So we'll cut him some slack in that regard. Otherwise, you see that most of these did finish in the green today. One of the bigger movers from a mega cap perspective was Philip Morris International. That $158 billion company closed up by about 3% here today. That's actually a stock that we're selling puts on right now in my options for long-term investors class. So good to see that one shaking out pretty nicely there. Let's see what happened in the energy world. Looks like we had more down movers in the energy patch than up movers, so that was more consistent there. I would imagine we'll find when we have our 12 grid analysis that XLE was probably one of the worst performers today, because remember, Exxon and Chevron are the two commanding presences within the XLE. We actually talked about that in my question and answer session earlier today. Those two, along with Conoco, probably represent about half of the importance of XLE from a market cap perspective. So tough day there for energy in general. Little bit of a split decision in financials, although I would say it tilts more bearishly from my eyes perspective. You do see that the the capital markets in the middle seem to do a little bit better from that industry perspective, but your more traditional banks and insurance companies did suffer today. And we did have a pretty long conversation about insurance stocks in my question and answer session today as well. Let's see what happened there in healthcare. I would say it tilts more bullishly in healthcare, with stocks like Stryker up about 3%, Moderna, of course, behind the COVID vaccine, up 3% here today. We had Catalent up about 4% today. We had Teleflex up over 4%, so some decent movers there, but it is somewhat being masked by the fact that the largest healthcare company these days is United Healthcare. It's usually back and forth with Johnson & Johnson. Yeah, right now United Healthcare is a $500 billion company. J&J is just shy of that at $467 billion. So right now the big kahuna within healthcare is United Healthcare itself, and they struggled here today, down about 2%. So that probably put a lid on the performance of XLV in general, but if you were to kind of break it down on a stock-by-stock basis, I think you'd be happy with a little bit more bullishness than immediately meets the eye. From an industrials perspective, here you can see it was, again, a little bit of a mixed bag. I would say it probably tilts a little bit more bearishly because you do have some of the bigger players like Honeywell, Union Pacific, Boeing, Caterpillar down on the day. On the flip side, you did have Raytheon up and then also UPS up here today. Of course, imagine you'll see a lot of brown trucks running up and down your streets as we head into the holiday season here. Talked about technology already. Let's take a look here at materials. They look like they had a pretty strong day. Materials don't really get the press and the headlines that a lot of other sectors have. We don't talk about them nearly as much, but reasonably strong day for them, with the best performer being the gold miner, Newmont Mining, up over 2% right there. Real estate kind of tilted a little bit more bearishly here today, kind of offsetting some of that enthusiasm that we saw on Tuesday when every single one of these was up. Today, we didn't have a clean sweep to the downside, but it was definitely more bearish than bullish. And then last but not least is utilities. And there we probably swung a little bit more bullishly, especially knowing that the biggest market cap companies of NextEra Energy, Duke Energy, and Southern Company all were up. We're actually in a trade right now in Southern Company in my factor-based swing trading class. So we'll see if that one keeps on motoring a little bit higher for us here in the short term. All right, so now that we've got that out of the way, let's go ahead and flip back on over to the main part of the platform, and let's take a look at some charting analysis, starting with this chart 4B. Remember, for those of you that are premium members of Market Scholars, you're welcome to follow along with David and I during our presentations by pulling up these charts on your own as well, as we do give you access to all 50 plus of those customized charts that we offer. And that includes all of you who so kindly joined us over the last weekend. Of course, we had our big Black Friday sale, and so we welcomed in a number of new members there, and we're happy to have you on board here at Market Scholars, and we appreciate your business. So this is chart 4B. And this allows us to see all four of the major U.S. equity indices all together and get a sense of what the market forecast technical indicator is telling us on all four of them at the same time as well. And the first thing that I'll point out, I had already mentioned there briefly a moment ago when I talked about tonight's email will probably have a number of stocks that have overbought cluster signals, and the reason that's my belief at this moment is because the S&P 500 closed with an overbought cluster signal itself. Now, those have been relatively few and far between lately. We were tracking this in my question and answer session earlier today, and it was flipping back and forth, and we weren't quite sure was it gonna close with one or was it not going to close with one, because it really just depended of whether it was going to close near the lows of the day, in which case the cluster would have disappeared. But in this case, since it held the line and basically closed break even, it was officially down 0.09% today. That was enough to produce that overbought cluster signal. For those of you that are not familiar with that term, because quite frankly, we haven't had that conversation in over 3 months, down below here, you will notice on the market forecast technical indicator that we do have all three of those market forecast colored lines in the upper reversal zone at the same time. We have the green line, the red line, and the blue line all above the 80th percentile. And remember, you can read those in these labels here as well. So the momentum line was just barely above 80 at 84. The near-term line, the blue line, was much more into the upper reversal zone at 92, as was the green intermediate line around that same level. So today was a rare overbought cluster signal, and as you look at this chart, notice that on the S&P 500, this is the only red dot you see on the chart. Now remember, the red dot down below corresponds with the price candle up above, just letting you know that it's this signal down here that is putting that red dot up there. We had plenty of green dots back here. Remember, it's it's kind of crazy to think about, honestly, because it really wasn't that long ago. It was just at the end of September, beginning of October. But we were talking about how historic this was to have so many oversold cluster signals in a row, and how that had hardly ever happened throughout history, and that we were due for some sort of a market response to the upside as a result of those extreme oversold conditions. And now here we are, basically knocking on the door of 3-month highs after it was all said and done. It didn't feel like it resolved itself quickly, but it did certainly resolve itself with one of the most aggressive 2-month rallies that we've seen here in quite some time. Both of the last couple of months, with yesterday being the final day of November, closed higher by 5% or more, both October and November. So that was quite the response in the end to all those oversold cluster signals. So now the question is, will we have a response to the overbought cluster signal? And if so, will it happen relatively soon? Or will we be in a situation where it starts plotting a whole bunch of these red dots, similar to how it plotted a bunch of these green dots over here? Of course, we'll never know for certain, but in general, these clusters usually do not show up in unison day after day after day. That's why we spent so much time obsessing over them over here and talking about them endlessly, because of how rare this was. Typically, you don't see that type of behavior. Let's go ahead and zoom in on this chart by right-clicking and maximizing the cell. And then let's go back on a 6-month basis instead of on a 3-month basis and see if we can discover any. Even on a 6-month basis, we have not had an overbought cluster signal until right now. Let's go back on a yearly basis now. And here on a yearly basis, we can spot one other example of the overbought cluster signal, and that happened back on March 25th of this year, 2022. And as you can see, it ended up being a pretty good selling signal for the market. Had you sold or shorted or bought puts or bought some futures contracts that leaned more bearishly, or whatever you chose to do at that time, you might not have been too thrilled with your decision after 2 days later, because the market did go up for another 2 days after that. But I think looking back where we've come from now, I think a lot of us would have been quite pleased to start putting on some bearish trades back here on this day. Even if we didn't nail the top perfectly, which was 2 days later, we still would have had a major benefit to having some bearish deltas in our portfolio after that. So who knows whether this time shakes out the same way, but it is just a reminder that typically you don't get a whole bunch of these red dots all together. And so this one could very well be an important signal. The other thing that I would mention is that a lot of people have been looking for that 4,100 level on the market. And I talked about this a bit in class here today as well, but I'll kind of address it at this moment too, here in this free video on YouTube. Today we did touch 4,100. And when I say we touched it, I mean just barely. Notice up here where we have the H colon. I know some of you watch these presentations on your smartphone, so you're going to have a hard time seeing this. But for those of you that are watching this video on a normal large screen, either monitor, computer monitor, or perhaps some of you remember watch these videos on your big screen TVs, which is kind of cool too. You actually watch these market outlook videos in your living room on the big time TV where you watch your movies and everything. So anyway, hopefully most of you will be able to see this, but if you look at the H colon up here, when I point at that candle of today, notice back at that H colon, it says 4,100 spot 5-1. So when I say it touched 4,100, I mean it literally just touched it and immediately turned around. There's been a lot of people that have been waiting to see what is the reaction once we get to 4,100. And part of the reason behind that is because if you were to draw a trend line, so let's get our drawing tools out and let's do this trend line tool right here. and kind of take this high point. Remember, for the S&P 500, we actually hit our high on January 4th of this year. That was a little bit different than NASDAQ. Remember, we just passed our 1-year anniversary of the top on the NASDAQ, but we have not yet passed our 1-year anniversary on the top of the S&P 500. So this candle right here up at the top is the all-time high of the S&P 500 just back in January. And if you were to kind of drag a trend line over the tops of these candles to the best of your abilities. Of course, it's a little bit hard. Sometimes it's in the eye of the beholder on how you draw these lines, but you can kind of see the gist of it. And I know that's a pretty thin line, so let me right click and edit this, and let's make this a little bit wider. So I'll make it stand out quite a bit more with the width of 5 there. So you can see what I'm talking about here. Notice that if we were to drag this trend line from our top back here on January 4th and drag it over the tops of these candles on this subsequent high back on, let's see, it would have been March 30th, and then once again drag it across the tops of this other high on August 16th, it basically leads you right here to 4,100, exactly where we touched today. And it wasn't a very strong response from the bulls. So that goes back to my comment earlier in the presentation where I said, if the bulls want to blow this out of the water, tomorrow's their chance, right? If they can get another candle that looks like this that happened yesterday to happen tomorrow after the jobs number, then this market will be leaning decidedly more bullish. On the other hand, if the bears finally roll up their sleeves and stop getting kicked around like by the bulls like they have been for the last month and a half, tomorrow could be their excuse, their catalyst to finally sell this sucker off because you finally reached the underside of this downward trend line at 4,100. So it's going to be really, really interesting to see how the market reacts to the jobs number tomorrow morning, and especially how it closes. Because remember, there's plenty of times where we have head fakes during the day, and that jobs number is released before the normal market session. So there's probably going to be some choppy, more volatile trading activity tomorrow. And how we close tomorrow, especially since it's a Friday, that's also how we close the week, will be quite important in how markets are tilted from this point forward. So I don't want to put like too much emphasis on it, right? You always hear that anytime you watch like CNBC, they say, and we're on the cusp of the most important earnings season in history. And then they'll say that exact same thing the next quarter and then the quarter after that, right? So they kind of try to hype it up a little bit more. So I don't want to be the hype guy here, but it is true. To me, it is a very important day tomorrow because we finally touched our 4,100 today, and now it's time to see how does the market want to react to that number. So we'll all be waiting with anticipation, but considering we've got this overbought cluster signal associated with the resistance area of that downward trend line, I would not be surprised at all if we give back some of those gains tomorrow. So we shall see. It's going to be interesting. Let's take a look at our other charts now. And you can see that the Dow Jones was down 0.56% today. And that was pretty rare because remember, one of the themes of this move over the last couple months is the outperformance of the Dow Jones and the blue chip stocks. We've seen that give way a little bit after yesterday's epic rally where some of the growth stocks have come firing back here in the last, let's call it 24 to 48 hours. Now that doesn't make a trend, but it's at least worth noting. Today, the Dow struggled a little bit more, and that could very well be because United Healthcare was down, as I mentioned before. United Healthcare, being a high price stock, has a bigger influence on the Dow than Apple does because United Healthcare's price is larger than Apple. It doesn't make a whole lot of sense, but it is what it is, and that could very well be the reason why the Dow struggled today. And also keep in mind Salesforce.com, CRM, that company that I had mentioned before, that was the worst performer in the S&P 500 after their earnings announcement. It was down 8.5% today or whatever it was. They're in the Dow. That always surprises some people because a lot of people think, the Dow, that's kind of like General Motors and U.S. Steel and that kind of thing, right? They think of old school Dow. Well, these days, there is more technology in the Dow than there had been in prior decades. And one of the kind of stranger selections that the Dow has made here in recent years is, awarding Salesforce.com to be a component of the Dow. And so that really kind of hurt them today because Salesforce.com is a stock that's $150 in price, and it was down over 8% today. So I'm sure that had a pretty big impact on the Dow today as well. But similar to the S&P 500, notice that the Dow also has a overbought cluster signal with this red dot appearing down below, showing us all three of those colored market forecast lines in the upper reversal zone on the same day. Notice that it just barely completed it with the Dow because the momentum red line was at 80.18. Remember, if that would read 79.99, that red dot would not show up. So by the slimmest of margins, you also have an overbought cluster signal on the Dow. Now on the two down below here, notice that we just barely missed the cluster signal. With the NASDAQ down below here, it was up 0.13% today, and you'll notice that the green intermediate line finished at 79.32, so just under 80.00. The other two lines would have qualified. The red line and the blue line were in the upper reversal zone, and it's the same thing with the Russell 2000. Notice that, actually I take that back, the Russell 2000 had two things missing. The red line also fell just barely out of the upper reversal zone at 78, but also similar to the NASDAQ, its green intermediate line was at 79.6. So with the Russell, it's hard to kind of see it here with the naked eye, but it only had one of the three in the upper reversal zone there. But you can see how close it could have been. Had the Russell closed at the high of the day today, it would have been an overbought cluster signal there as well, but they did close lower by 0.26%. So all four of those indices were basically within just the slimmest of margins of having overbought cluster signals. All right, let's go ahead and now, before we go over to the internet briefly, just to wrap it up, we do continue to have strongly bullish postures across the board. And so be aware of that. You can see that we've got green background colors on all four of our charts, and all four of them are above their rising 30-day moving averages, which is why those lines are all colored green right now as well. Okay, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this free presentation here that we do pretty regularly here, most of the days when the market is open, of course. As always, appreciate those of you that go out of your way to click like and retweet and all that good stuff on Twitter. As long as we're up and over 100 likes, I'm more than happy to do a full-length version of these videos, and 111 of you stepped up for me the last time around. So let's go ahead and do some shout-outs here to say thank you to Violina and GJD, Ayakipa, Ken, Irene, Tammy, George, Carlisle, Rhonda, Lucius, Evan, Tom, HR, T-Fib, Dan, Doug, Robert, Jayesh, Jerry, Floyd, Roger, Valerie, Paul, Kirkeye, Prickly Trader. We've got Dave and Gerald and Paul and Tim and Vodacon and everybody else. There's a lot more names there. I can't get to all of you, but do want to recognize you and say thank you for taking the 5 seconds out of your day to help support us by clicking like there on Twitter. That's the best way that David and I can get the word out about our fledgling business. So we really do appreciate that, and it helps incentivize us to spend the 3 hours that we do preparing these videos for you each day. So thank you once again to all of you, and I'll make the same deal for you next time around if you're willing to step up and do that for me again. On Tuesday, I'll plan on doing another full-length video if we can get up there and over 100. So keep up the great work, and thank you very much. I really appreciate that. Also, had a great day of content here at Market Scholars. I taught my question and answer session, and David taught his portfolio management with ETFs class. As always, we had a lot of great content to sink our teeth into in terms of the questions. It was another 3-hour and 30-minute extravaganza for me with my students today. So I had a question about where to register for classes on our website. Since today is the first day of December, remember, all of you who are premium members can access a link that will allow you to register for all of our classes for this month, all at the same time. So that's a nice benefit that you premium members get. Also, I got a question about kind of deciphering between growth, income, and value labels and how I kind of think about those. Also got a question about how to interpret our 5 green arrow process that we use in my top-down trend trading class, and how do we think about that with the stale label versus the fresh label, and how that might influence us in how we either think about buying stocks, or perhaps how do we adjust our positions once we're in them. I also got a question about how to interpret the Morningstar star rankings. We first talked about how their star rankings work on individual stocks, and then we transition the conversation to how Morningstar star rankings work on ETFs and mutual funds. Also got a question about Novartis, a healthcare giant from Switzerland, and whether it would make for a good dividend growth investing candidate. I also got a question about how to think about the various dividend growth investing insurance carriers. For those of you that have been to my classes over the years, you'll know that Chubb and Travelers and Allstate and Prudential and Cincinnati Financial and a number of other well-heeled insurance companies have made their way into our portfolios. And so the question was whether we should be concerned about that with a whole bunch more storms these days than what we had traditionally, and what my thoughts were on that. And my thoughts may be a little bit surprising to some of you who have never heard me talk about that particular subject before. I also got a question about how to use the Ask the Assistants forum on our website, which is a neat little feature that we have where not only do students get a chance to ask David and I questions, but there's also an opportunity for them to ask one another questions. And there are peer-driven forums on our website where they can get some assistance from the other students and clients that we've had over the years. We also got a question about are there differences between paper money and real money accounts and what those differences are. Also got a question about why do bond ETFs go up or down based upon interest rates and other things. Got a question about I bonds or inflation adjusted bonds and how to kind of read the information that you see on the Treasury Direct website. Also got a question about where do I find the dividend growth investing resources on the Market Scholars website. And then I got a question about some financial stocks, Franklin Resources, and then Fidelity National Financial, and how a recent spinoff recently occurred, and what my thoughts are on FNF these days. So anyway, if any of that commentary sounds interesting to you and you are a premium member of Market Scholars, that has now been posted. Remember, you find those premium classes by clicking on the Trading Rooms tab on our website. And then the posting is recorded, or the recording is posted right within the calendar itself. All right, also let's have a little chat here about the Factor Selector tool. A reminder that the Factor Selector gets updated on Tuesday nights, so it's a couple of days stale at this point, but can still give us a general sense as to any rotations that might be taking place. And remember, the factor view is different than the sector view. Sometimes you can have some strong correlations, but in general, they are independent from one another. And so this week, dividend yield remains number one yet again. And for those of you like myself that are dividend growth investors, you'll know that we have had things very, very well here in 2022. In my case, my Roth IRA literally hit an all-time high yesterday. So I know I've heard from some of the rest of you as well that you've experienced some of the same things. It's not like we're making gobs of gains this year, but like I mentioned to someone on Twitter, the fact that there's any gains available is something that we should cherish in a year like 2022 that has been quite difficult for other groups of traders and investors out there, those that have focused on more growth and innovative, disruptive types of companies. They've suffered in a lot of ways this year. So it's been a very peculiar year where dividend stocks have done tremendously well, especially on a relative basis, and that is bearing out here on the factor selector. And then on the bottom of the factor selector, we've got low size. So some of the smaller companies out there starting to struggle and replaced momentum on the bottom. Also, I wanted to quickly point out that last night before I went to bed, I did post the dividend stairstep sector statistics for the month of November. So for those of you that aren't familiar, I started doing this earlier this year. I probably started back in maybe May or something like that. But anyway, the point is at the end of each month, I'm trying to evaluate on a sector by sector basis where the most attractive opportunities are for dividend growth investors, where their dividend yields are relatively high compared to their historical measures. And so I'll plan on going through my analysis of this information in the Monday options for long-term investors class for those of you that are premium members. But for the rest of you, if you wanted to check it out in the meantime, remember this particular area of our website is available for free, so you don't need to be a premium member to just view the information. So if you're looking for it on our website, you just go to marketscholars.com, hover your mouse over the blog tab on the main menu, and then click on dividend growth investing as that sub menu right there, and you should see that as the most recent post. I'll plan on also putting another post out over the weekend, perhaps as soon as tomorrow, about the companies that raise their dividends in the month of November. See what we can learn from those as well. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis. So let's start off with chart 5A. This is our asset class 12 grid. And it was an important day from a interest rate perspective. Not sure how much of the business news you as an individual might have caught, but I would say that was one of the bigger stories of the day. Interest rates really rolled over in a major way. You can see here that the 10-year Treasury yield closed today at 3.52%. And that is its lowest close since going all the way back here to September. And remember, this was the market's biggest challenge for the longest time, is that interest rates were going up and up and up and up, and the stock market kept on going down and down and down and down. And now, ever since basically October, we've seen the opposite. Interest rates have started to be rolling over there, and of course the stock market has responded in kind to the upside. Now you'll notice that the selling in interest rates has been aggressive to the point where you do have yet another oversold cluster signal showing up here. You did have a couple last week as well. You had a little bit of a reversion to the mean move, although it wasn't all that aggressive until we had the last 2 days of selling, and now we're setting up for another possibility there. So naturally, when you have a big move lower in interest rates, the opposite effect happens to bonds, even bond ETFs, going back to that question that I addressed in my Q&A class today. Remember, when interest rates go down, it drives bond and bond ETF prices up, all else being equal. So we shouldn't be surprised to learn that today TLT had one of its biggest days in quite some time. Long-term U.S. Treasury bonds were up by almost 3% today. Remember that the full year's worth of interest is around 3.5%. So you're talking about almost an entire year's worth of interest payments that's being delivered to you in the form of capital gains in one single day for bond funds here today. So it was an enormous day for bond funds to the upside. And it wasn't just the U.S. government bonds that were getting involved. Notice that foreign bonds also had a good day. They were up 0.45%. And you'll notice that foreign bonds has a little red dot showing up above the candle today. So similar to the S&P 500, that means we have an overbought cluster signal there. And of course, that makes sense. When interest rates are falling until the point that they get oversold cluster signals, then the opposite is also oftentimes true, where bond prices are being pushed up so much now that they actually have overbought cluster signals. And then speaking of which, down below, notice we have another overbought cluster signal in the gold chart. Let's go ahead and right click and maximize that cell so we can see it a little bit better here. And you can see that the green, the red, and the blue lines on gold, GLD, all closed in the upper reversal zone on the same day. And again, similar conversation as SPY. My oh my, how the tables have turned, because for the longest time earlier this year, gold was really struggling, but this has been a rather impressive move. Of course, been talking about it a bit, saying how this move felt more real to me. It felt more legitimate. It actually had the juice to sustain the adrenaline push to the upside when we breached this prior resistance area right here with this gap up. So we continue to go up for another 4 days. We basically did a retest of that level, and when that retest held up and was successful, these last 3 days have come as quite the blessing. If we were to go back further And let's go back 6 months to see if we've had any overbought cluster signals. We have not. And then let's go back 1 year, and we would have to go all the way back here to March 4th. Remember when we did this on the S&P 500, I think it was like March 23rd or whatever it was, so later in the month. But earlier in the month of March, gold had its overbought cluster signal. And in this case, similar to what I mentioned with the S&P 500, the next 2 days after that, it kept on going. Remember, there's no guarantees in this business. It's not like the market knows that these random overbought cluster signals on the market forecast technical indicator that not a whole lot of people use outside of David and I, and of course all of you. It's not like the market is just going to stand in its tracks and be like, oh, okay, well, now that there's a overbought cluster signal, we must reverse course. Of course, it doesn't work that way. So there were 2 more sizable up days after that initial overbought cluster, but after that it was kind of like a blow off moment, and gold just collapsed, and that ultimately ended up being the best possible time to sell gold over here. For whatever reason, my gut tells me that this time you stand a better chance of seeing more substantial moves off of this. I don't know, I could be wrong about that, but remember how I talked about the S&P 500 and how you could draw a trend line, and you were kind of butting your head up underneath the underside of that downtrend line. If I were to draw a trend line on gold, you've already broken beyond that trend line. You've already established more bullishness over here. So I wouldn't be surprised if GLD has a better chance to sustain the bullishness over here than the market at large. We shall see. But right now I did find that interesting because it's been so long. It's literally been like 8 or 9 months since we've been able to talk about gold with an overbought cluster signal, and that's what's happening right here, right now, today. It's been quite the recovery there for that particular commodity, especially when you compare it to oil, because earlier in the year it was oil that was taking off to the upside, and it was gold that was doing poorly. Fast forward to where we're at right now, and it's kind of like a role reversal where gold is doing much better than what we see with oil, which has kind of been choppy and sloppy to the sideways, whereas gold has been a more legitimate breakout to the upside. Notice that with oil, you were up today, but just barely up 0.31%, so up less than gold's 1.84% advance. And I'm not particularly enthusiastic about the oil chart right here. Yes, it's true, oil's been up 3 days in a row, so credit where credit is due, but I don't really like the way that it handled this perceived resistance area here at the same time. Notice that you basically closed right at the 30-day moving average, so it kind of leaves you in limbo, wondering, does it have the juice to break up and continue that move of the last 3 days? Or is this kind of giving us the impression that it's running out of gas, pardon the pun, with oil here, at around these levels? And the reason I bring that possibility up is you'll notice, we basically have one of those kind of black filled in candles right here, just like we did back here, which led to some selling immediately afterwards. You saw another pretty big black filled in candle right there that led to selling immediately there afterwards. And, it makes you wonder if you're kind of going to see the same type of thing here after you've had this initial reversion to the mean type of a move. Is it now going to use that moving average as resistance and bounce back down and away from it? So I'll be curious to see how that shakes out, but let's keep our eye on that possibility there. Bitcoin was down just a touch here today, not a huge day for it, but it did close below 17,000. It had a pretty nice rally here yesterday alongside the rest of the risk assets in the market, but kind of gave back a little bit of that here with today's move. But, you can see with Bitcoin, it remains in a pretty strong downtrend. Even if you were to pull up /BTC, you can kind of see the same thing. It's still down below its falling 30-day moving average. Here you do have a weekly bullish posture. So if you use the futures versus the index, there's a slight difference in how the posture setting mechanism works for the market forecast technical indicator. But whether you're looking at one chart or the other, I think we can all see clearly that it's still down below that falling moving average. So it's got work to do, but we'll find out soon enough whether it's got the juice or not to get to the upside. It's been kind of interesting watching. Yesterday on CNBC, they had that Sam Bankman-Fried being interviewed by Andrew Ross Sorkman on the Deal Book, and it's just kind of interesting how this guy that's a younger fella. I'm in my mid-40s, so I'm getting up there in age myself. But there's a lot of the younger generation that probably looked up to this guy, and he was kind of perceived as a guy that was ushering in a new era perhaps. And just to see him answer these questions and give the answers that he did kind of made you wonder if anybody was tending the bar, so to speak. It just kind of seemed like the way he was answering the questions, his mind was out in La La Land. I don't know if he was actually trying to be fraudulent. It's hard to say, but it almost makes it seem like he didn't have a real good, firm grasp on the company's risk management at a very minimum. So there is something to be said for having a little bit of experience in the management roles of a lot of the individual common stocks that we oftentimes are attracted to. A lot of times the old fuddy-duddy management team gets poo-pooed by the younger generation, but there are also times when it's important to have an adult in the room, so to speak. And of course, that's come up a number of times over the years at Google and a lot of these other up-and-coming new economy stocks as well. So sometimes you learn the hard lesson, and I'm afraid that a lot of the folks that trusted FTX learned a very hard lesson this time around. So it seemed like it had a little bit of a denting of the reputation of the crypto space in general, and it's good to see that Bitcoin has stopped going down the way that it was right when that scandal was breaking, but we really haven't had enough of a sizable rally to the upside to say that we're back on the bullish train quite yet. On the top rung of these charts, you can see that not only did the U.S. stock market close with an overbought cluster signal, but you also have EFA, which tracks the foreign developed markets. Think about Europe, Japan, Australia, and the like. They also closed with an overbought cluster signal there. And I would imagine that's probably been a long time for that asset class as well. Let's go ahead and check it out. I'm going to go back on a one-year chart here. And this is actually the very first one in a year for EFA. Now, remember what I had mentioned to you on Tuesday's video, that this is 6-month highs for relative strength of EFA versus the U.S. stock market. So we've really seen an acceleration of stock price movement here in EFA, and this just proves that point even further. This is literally the first time in a year that we've had an overbought cluster signal. Let me see if we can go back 2 years, still staying with the same daily aggregation period. And here you can see that the last time we had an overbought cluster signal on EFA was back in August of 2021. Seems like an eternity ago. But back then, that would have been a pretty good time to think about selling this particular product. Yes, you did have another high here and another high here where you could have got out at approximately the same point, but that was a topping pattern that was taking place back in mid-2021 that eventually led to an onslaught of selling. So, of course, a lot of those oversold cluster signals started showing up after that. But anyway, it just goes to show that we've had a pretty enormous rally there for EFA. Not a whole lot of people are talking about it, but we've been trying to bring it up here in these videos because we try to remind you that when the US dollar breaks down, like it has down here in the lower left, foreign securities have a better chance to outperform U.S. securities, and we have actually seen that. If you don't believe me, just by looking at the charts, look at the little numbers to the right of the charts, and that tells you all you need to know. Right here, what I'm circling with my mouse on EFA shows that over the last 3 months, EFA is up 11.34%. The U.S. stock market is only up 2.76%. So Europe, Japan, Australia, doesn't sound like the most exciting places on the planet to be investing because they've kind of been left behind over the years. But right now, they are having their moment, their moment in the sun. They are really clicking to the upside. All right, let's go ahead and now take a look at our sectors. And for that, we will pull up chart 5C. And it's the same story as what we saw when I was last with you on Tuesday, which is there's only one chart that's in the pink right now, and that's energy. And I'll continue to use the same word that I used with you on Tuesday and that I've described to my class last week as well. It's a highly technical term. It's called wobbly. And of course, I'm just being facetious there when I say that. But that's how I kind of feel the energy stocks are right now. They feel wobbly to me. They were not always wobbly, which is why I've been spending a little bit more time, pointing that out, because there's been a lot of times this year where energy stocks were stalwarts, and it felt like they had so much strength that nothing could break them. That's not how I really feel about energy stocks right now, and I would not be surprised if they do start breaking down at some point. So we shall see, but at this moment in time, they are the only ones that have that weekly bearish posture according to the market forecast technical indicator. On the other hand, we don't want to overdo the negative sentiment when I say something like that, because the truth of the matter is you are still above that rising moving average, and we have seen times in the past where it just needed to catch its breath and then it goes on another big rally. So what I do know is that energy from a business model perspective is one of the stronger areas out there, right? If it wasn't for energy, we would be in a world of hurt in terms of earnings growth in the United States this year. Energy is really bailing out the other sectors. So their business is booming. It's just a matter of whether the stocks have already priced that in or not. And of course, commodities prices are volatile. And if commodity prices do start falling in more of a free fall type of a fashion, then of course those once really attractive profits. I was trying to think back to President Biden's speech where he said that ExxonMobil was making more money than God. So that's how you can kind of think about that in the back of your mind, is that they are incredibly profitable this year. But that can go away very quickly, way more quickly than something like the consumer staples or the healthcare or utilities, right? Those are non-cyclical areas where once you're making money, it's not like it's just going to disappear overnight in most cases. But in the energy patch, that can happen. Energy stocks can fall on hard times very, very quickly if oil prices fall out of bed. So they kind of have to acknowledge that they're operating in a much more volatile environment. As I always say to my Monday morning students, it's kind of like riding a bucking bronc when you're trying to trade energy stocks. You know, if you're lucky to stay on them for 8 seconds, you're doing pretty good for yourself, because it is a very volatile experience due to the fact that they kind of take their cues from commodity prices themselves that are basically influenced by geopolitics and a lot of other supply-demand dynamics out there that go well beyond what most corporations have to deal with when they're just trying to establish how much they want to sell their product for. Anyway, besides energy, all the other sectors do have strongly bullish postures at this moment. You can see which ones do have the red dots above today's candle. No surprise, technology. I say no surprise because remember, technology is still the most important sector in the S&P 500. So when the S&P 500 itself has an overbought cluster signal, all else being equal, the sector that would likely be joining them at the highest degree would be technology, because that's where you've got Apple and Microsoft, the two most important companies in the S&P 500. You can also see that industrials ended today with an overbought cluster signal. You can also see that materials ended the day with an overbought cluster signal. You can also see that healthcare ended the day with an overbought cluster signal. And you can see that staples ended the day with an overbought cluster signal. So again, I haven't checked the individual stocks yet. I usually do that when I'm preparing the email after class, but I'm even more convinced now that you will see a lot of overbought cluster signals on an individual stock basis. It wasn't just a fluke that the S&P 500 got it. You've got several sectors that also have that, which means that a lot of stocks within those sectors will end up having overbought cluster signals there as well, which sets up that possibility that tomorrow could be one of those down days, depending upon the interpretation of the jobs report. There's a decent chance that there's just been too much bullishness out there to produce these overbought cluster signals, and we may be due to give some of that back. Too much of a good thing is the way that you can kind of think about those signals. It's not necessarily bad from a trend perspective. It's basically saying trends are being established, but it basically is meaning that we are going up too far too fast at this current moment, and we need to slow that pace down. And a lot of times that's met with either sideways behavior or perhaps even selling. And the fact that we're up on the underside of that falling trend line on the S&P 500 kind of puts you in that camp where there's a better than not opportunity that there could be some selling on the horizon in the short term. Anyway, today's best performing sector appears to be, might be this one over here. It might be healthcare. Yeah, I think it was healthcare. They were up 0.29%. And then the worst performing sector today appears to be financials. Remember, JP Morgan, Bank of America, and whatnot were down today. So financials were down 0.58%. So it was not a volatile day across the board. We didn't have a single sector either up 1% or down 1%, and that's pretty rare. So it tells you how quiet things were here today. All right, let's go ahead and get into our trade application example now. And I'm just going to pull up chart 3A for that, which I oftentimes do for these trade examples. And the stock that I want to talk about here today is a stock that is embroiled in a takeover. And this is a gaming company, Activision Blizzard, ticker symbol ATVI. And when I say gaming, I'm not talking about traditional sports. Some of you might have seen I was wearing my USD Coyotes hat on the intro of the video. David and I will be enemies for one day this upcoming weekend when my South Dakota Coyotes are going to be the visiting team to his Cougars, and I'm fairly certain his Cougars are going to trounce my Coyotes, so I'm going to have to do my best not to get too upset about that. But it's a rare time where our two alma maters will actually face one another, as they generally are playing in different conferences in different parts of the country. So we're going to have a little bit of fun with that on Saturday. But anyway, not that type of gaming company. I'm talking about video games, electronic gaming. Activision Blizzard is one of the biggest video game software companies on the planet, and many of you are probably aware by now that Microsoft wants to buy them. But there is a lot of questions around whether that can actually get done or not, because the price that Microsoft wants to buy this company at is $95 per share. As you can see up here, it's trading at $75 per share. And Wall Street is typically not in the habit of just giving away free money. So this is effectively like saying that there are major question marks on whether that deal can get done or not. We know Microsoft is good for the money. They've got money growing out of their ears. So it's not a matter of whether they can finance the deal. It's a matter of whether the Justice Department will allow the deal to go through, or whether they will say that Microsoft will be too powerful. Because remember, Microsoft already owns Xbox. And, there's been a temperature change in Washington, D.C. in recent years around companies, especially tech companies, getting too powerful. So there is a legitimate chance that deal does not go through. But in the meantime, there is maybe a tradable opportunity in this case. And as those of you who are our premium members already know, because I did this trade while the market was open and sent out the details on our Telegram app, what I ended up doing here in Activision Blizzard's case is known as selling a bull put spread. And the idea behind that particular strategy is to sell one options contract and then buy another options contract, thus forming a spread. And in this particular case, the strike prices are below the current price of the stock. And the strike prices I selected were the 72.50 put to sell and the 70 put to buy in the month of January. And you can see where my blue line is down below here at 71.76. That's my break even for that trade, because I think we collected like 74 cents for selling that spread. And so that represents where I do not want Activision Blizzard to go down below. And you can see that that teams up pretty nicely with where you found a support level back here. You breached it just barely here on that earnings date. But other than that, it's done a very good job of staying above this level. And what kind of attracted me to it here today was obviously it was a very nice bounce up and off of that moving average, which I like to see. The background color of the chart went to blue, telling us that the near-term posture is now bullish. And you'll notice that we also have a bit of a bullish near-term divergence signal. Notice that we've got a low point on this blue line right here on the 28th. You have a follow-up low point on the 30th, and that follow-up point is higher than the original one. But when you look at the price candles associated with it up above, here's price candle number 1, here's price candle number 2. Price went down at a time when the indicator improved. So it was similar to that Norwegian Cruise Line trade that I did on Tuesday. That one's making money right now, but it's not really setting all that well with me, because the very first day after the trade was placed, it went down, and luckily it has recovered a little bit. So I'm feeling a little wobbly myself about that Norwegian trade. And as I mentioned to you at the time, sometimes I get a little bit leery trading the low price securities because I think they can get pushed around and manipulated a little bit more. Activision Blizzard probably has a lot of well-heeled investors in it, including Warren Buffett. Remember, there's a lot of arbitrage folks that are playing this because they're trying to capture the difference between where the stock is trading and where Microsoft wants to buy them out. So I don't expect this type of company to be pushed around nearly as easily as Norwegian Cruise Lines, unless there's some sort of a major news announcement that says, hey, Microsoft is calling off the deal or something crazy like that, which I'm not expecting right now. So anyway, just a bullish setup where we basically applied a put sale on it, which is a bullish technique in the options world, where we want the stock to stay above 71.76. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. If you did, as always, I ask just one simple thing out of you. Trade your 5 seconds of your time in for my 3 hours of time that I go into preparing for these videos and producing them for you. As long as we're up and over 100 likes, by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video like this one, where we go into all the extra 12 grid charts and I present a trade application example for you, just like I did here with Activision Blizzard. On the other hand, if you prefer the scaled down version of the video, only the 15-minute version where you just see the analysis of the indexes themselves, then don't click like. And if we're under 100 likes, then I'll just plan on doing 15 minutes. That would actually save me a lot of time. So it doesn't bother me at all if that's what you guys prefer. But if you do prefer the longer ones with more analysis, then I just ask you to take the 5 seconds out of your day to click like for me there on Twitter. And I do appreciate all of you that do that for me. It means a lot. So that'll wrap it up for me for the weekend. David should be back with you tomorrow, but I'll look forward to joining forces with you early next week at some point. And let's all watch that jobs number tomorrow morning. Tomorrow is going to be a very important day, given the fact that we touched 4,100 on the S&P 500 today. And if the bears are going to make their move, tomorrow would be the perfect excuse day for them to try to pull it off. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.